Good afternoon, everyone. I'm Brian Johnson. I'm the president of MassMedic, and it's my pleasure to welcome you to another MassMedic Insiders webinar series, MedTech M&A from the financial buyer's perspective. This is a really great, rare chance to hear from some of the PE firms that are involved in this industry every day. We're pleased to present this content to you today with the support of our partners from MedWorld Advisors. MedWorld Advisors is a boutique mergers and acquisitions firm that specializes in helping small to medium-sized businesses in medtech, biotech, dental, life sciences, digital health, and much more in healthcare to reach their goals. They're based in Massachusetts, while their team of advisory experts is global. MedWorld was recently named number 6 on the Axial's top 20 lower middle market investment banks. So we're really pleased to be working with them today on this program. So during this webinar, we're going to be discussing M&A in MedTech from the perspective of the buyer. And our panel is going to be hosted by Daniel Sheppard. He's the Managing Director for Middle Markets at MedWorld Advisors. He'll be joined by Mike Magliocetti from Riverside Partners, where he's the operating partner, Steve Sandbo, principal from Vance Street, and Eric Tansky, the general partner from ExcelMed Partners. Just a quick housekeeping note before I hand over the reins to Daniel. This meeting is being recorded, and a link to view the recording will be sent out to everyone who registered for our webinar today. We also will have a chance for you to ask questions. If you want to, you can submit them through the Q&A tab on your control panel. And with that, I'm going to hand the mic over to Daniel and take us away for a great conversation.
All right. Thank you, Brian. And thanks to MassMedic for helping to support and host this event. Also, thank you to the panelists for joining. I will say special thanks to Eric for accommodating his schedule to have this fit in last minute, as we had to switch up a panelist that couldn't make it. So I really appreciate everybody joining, and really appreciate the audience for attending this webinar today. I think whether you are a business owner that could potentially have your business acquired by a private equity firm, whether you work for a company that has been acquired by a private equity firm, or whether that's something down the road, or whether you're just in the medtech in general, I hope this is an informative session for you. But before we jump into the main questions, I just kind of want to start with each of the three of you kind of giving an overview of your firm and kind of the elevator pitch on how you view the market. So, maybe Eric, as a special thanks to jumping in last minute, I'll go ahead and start with you and ExcelMed.
Thanks, Daniel. I was hoping you were going to say as a special thanks, let me go last, so I hear what the other guys say. But, no, thank you. Yes, Eric Tansky here, general partner at ExcelMed. ExcelMed is a lower middle market growth private equity fund exclusively focused on the health tech markets, which we define as traditional medical devices, life science tools, diagnostics, digital health, and technology-enabled services. ExcelMed has been in business for about 12 years, started as really a venture fund based in Israel, and has transitioned to be a US-based growth private equity fund. We're now on our second fund, which we recently closed, a $400 million fund, and we are aggressively out deploying capital. In terms of the market, I think you asked for, Daniel, from my perspective, I've been in medtech now first as a banker for almost 20 years. There have certainly been periods of time, especially around the Affordable Care Act, say 10 years ago, there was a lot, I would say, of change, in the industry. But, even with the pandemic, other than a brief pause in M&A activity right around the start of the pandemic, things, to me have felt pretty steady. I think we are seeing the prospect of a lot of potential tax changes, maybe more private, family held businesses coming to market. But, look, it's a sector of innovation. It's a sector that has a lot of capital regularly coming in. So from, my perspective, it's kind of, in a large extent, same old, currently, and be interested to see if my other panelists have a different view.
No, it's good that you mentioned a couple of those trends that are kind of driving activity right now, and I think we'll jump into those a little bit more as we continue through the webinar. Steve, I'll go ahead and turn it over to you in Vance Street Capital.
Yeah, sounds good. Thanks, Daniel. Yeah, so Vance Street Capital is a lower middle market firm with a very focused approach to investing in medtech and life science. And we like to use the term highly engineered solutions providers, which to us kind of means, MedTech manufacturing, life science manufacturing businesses that are focused on solving really difficult problems for their customers, doing it with speed, excellent quality, and really, to a certain degree, trying to stay away from the commodity subsegments of the market. So about 90% of what we do are entrepreneur-owned businesses or corporate carve-outs. And that's something where, we take an approach here at Van Street where about half of us are actually former operators. So we'll really try to think about how we can be more than just a check writer for a lot of these different businesses. So I think with that comes, the need to have a lot of flexibility in terms of how you partner with families and how you partner with entrepreneurs. But I think the themes that Eric brought up are certainly right. I would say to a certain degree, it's same old, to a different degree. I think we've seen a significant influx of probably newer, entrants into this market who've, we were chatting before this kicked off, the secret's kind of out to a certain degree. I think people really, are embracing, med tech and life science and, the unique manufacturing environment that's, causing a lot of these businesses to sustain the pandemic a lot better than a lot of other markets.
That's well said. All right, and saving the best for last, our home guy, Mike, in the Massachusetts area. I'll turn it over to you in Riverside Partners.
Thank you, Daniel. Riverside has been around for a little over 30 years, actually, and since day one, just focused in two verticals, healthcare and technology. And we cast a pretty wide net under the healthcare umbrella, everything from devices, diagnostics, contract manufacturing, pharmaceutical services, lab services, tech-enabled hospital services. And, we focus majority of founder-owned or majority management-owned businesses. These are companies that are on a relatively strong growth trajectory, not distressed in any way. We're not turned around guys. And these are typically companies that are generating revenues that yield EBITDA, greater than, say, 5 million. We're investing out of our sixth fund today and have around $1 billion under management. From my perspective, I think the market continues to be very frothy. I think there's a tremendous amount of money on the sidelines. I think we're kind of in this pandemic cycle, if you will, where because of the macro financial situation, there's government has been spending money to subsidize the economy. I think the cost of money has been historically low. From my standpoint, that's conducive to larger deals that we see, and the large strategics are sitting on cash and could be losing money if they're doing nothing with it, and they're incentivized to use this in liquidity to drive M&A. And I think as long as the cost of money remains low, we'll see this frothy market and valuations. I'm sure my co-panelists here can attest to the super high valuations that we're seeing. And when the cost of money rises, maybe the M&A cycle will slow down again. But that's what that we've been experiencing over the past couple of years, at least.
Yeah, I've seen that as well in the post-COVID area. I think we'll kind of jump back into that in just a second, Mike. Maybe before we kind of get into M&A, maybe each one of you could kind of describe what's one of the main current trends in medtech or healthcare that's driving discussion at your company. Steve, I'll start with you.
Yeah. Of M&A to a certain degree, it's looking at a lot of different businesses and looking at the impact on COVID on some of these different businesses and really trying to get down to the specific therapies. And I think it becomes even more challenging than that at times. It becomes how are OEMs or individual OEMs handling their inventory control or purchasing, and trying to understand as we look at businesses how impacted have they been or haven't they. And then certainly, I think the theme that everyone hit on here, which is continued level of activity and new, I hit on it earlier, just new entrants into the space, from a strategic buyer perspective. But those are certainly, I think, a lot of the themes and trends about right now at Van Street.
Mike, you wanna add anything to that from Riverside's perspective?
Yeah, for us, we've been really focused quite a bit on the investments in pharma and biotech, specifically the outsourced services, and I think this is another record year in this year. I think there'll be over 20 billion in VC investments in the pharma biotech space. And, think about large molecule cell and gene therapy for drugs for oncology, central nervous system disorders, rheumatoid arthritis. And so we really are like the CRO space and the CDMO subsegments.
Yeah, the increase in outsourced services has been a trend that's been driving the industry for quite a few years now. Absolutely. How about Eric? What's the current discussion at ExcelMed? What are the current trends that you guys are discussing?
Yeah, I mean, I'd say a couple of the key themes, Daniel. Digital health. We're very intrigued there. The deal activity and the valuations being paid, though it's challenging, as a private equity firm, I would say so, but that's something that we very actively look at. And, the data there in terms of the amount of investment that's gone into the sector is just incredible. And, it's not all going to end well. So, again, it makes it, you're intrigued, but it looks very risky. And, I'd say the second topic most discussed at our firm, because a lot of times, we do get very involved in our portfolio companies. I wouldn't call us turnaround guys. We do have thrived, I'd say, maybe some challenging situations. And the valuations, in the sector have gotten so high, and, sort of everybody thinks that, those valuations translate to their business. And again, it's a lot of discipline in the private equity seat, to not get caught up in that. So I'd say those are some of the key themes that we actively discuss.
That makes sense in this year. I think, as we've all seen, from either news headlines or just being a part of the industry day to day. I mean, MedTech M&A activity in the MedTech sector has significantly increased in the post-COVID era, or I guess in the COVID era, as we're still kind of in that. I think we kind of touched on this in some of your introductions. Maybe we'll just come back to this and expand on it a little bit more. What do you think is the key driver or drivers of the increased activity? And I'll go ahead and start with you, Mike.
Honestly, I kind of look at myself, the point of care diagnostic space. I mean, that's something that I look at the deals that have transpired over the past year. The Thermo Fisher acquisition of Mesa Biotech, for example. I mean, I personally love the diagnostic space, and that's an example of where molecular diagnostics is really kind of at the point of care has taken hold, and COVID has taken this whole subsector to an entirely new level. And the advancement of technology, PCR-based rapid point of care testing platforms for infectious disease, there's been a tremendous tailwind based off of COVID there.
No, I think COVID has impacted a lot of subsectors like diagnostics and telehealth, to where they've advanced probably what normally would take 5 to 10 years in just 1 to 2 years time. It's quite impressive. Yeah. Eric, how about you? What do you think some of the key drivers of increased activity is?
Yeah, I think it depends on which sector or segment of the market you're looking at. I mean, certainly you see deals like, Baxter Hillrom and, ICU Smiths. And, to me, a lot of that's driven by very low interest rates, just the cost of money. So I think that's a driver, on the large deal side. I think Mike's point's exactly right. I think it ties to a lot of what's going on the biotech side with these incredible breakthroughs they have there to treat cancer. The cancer diagnostics, call it, theragnostics. That was a moribund sector 5 years ago, and it's really, exploded over the past couple of years with all the advancements, in immuno-oncology. And I do think, again, for the privately owned businesses, the taxes and the prospect there driving a lot of entrepreneurs to look to transact now. So I think you have a lot of drivers. It just depends, I think, in where precisely you're looking, because if you look at like the traditional venture-backed medtech companies, that hasn't gotten much better. Like, you don't see too many pre-revenue, very early stage commercial. On that side of the market, the acquirers, I think, want to see real revenue traction and accretive transactions, and so we haven't seen, I don't think, much improvement there.
All right, and Steve, do you want to add anything as far as the key drivers of increased activity that you're seeing?
Yeah, I mean, I think Eric certainly hit it. It's probably a little bit dependent upon what segment of the market you're looking at. And I think for us, Advanced Street, our lens typically ends up being more on the MedTech side of the equation and typically entrepreneurs. So I think there was, to a certain degree, a pause in activity in Q2, Q3 last year while people were trying to figure out what direction their businesses were going to go in COVID and when they were going to see procedure volumes increase and how that was going to, affect their customers' purchasing patterns. And I almost think you then ended up with a kind of a tidal wave of activity that kicked off here this year. And then I think on top of that, the overlay of a changing tax landscape for entrepreneurs certainly I think has really caused an uptick in volume, at least in the activities that we've seen. But certainly echo what the other two panelists have said here.
I think that makes a lot of sense. I think, this next question is kind of a two-part question. I think, I'd like to know, so do you think that we are in an M&A bubble? Simple yes or no. And then, what have you seen as far as transaction multiples from 2020 to 2021? And do you think that will continue into 2022? Eric, I'll start with you on this one.
No, I do not believe we're in a bubble. And then in terms, honestly, on the valuations, I don't know that it's dramatically changed 2020, 2021. I think from my perspective, it has to work, for our LPs. I mean, each deal is going to be different and we have to make sure for each deal, our entry multiple makes sense relative to the exit multiple. I mean, case by case basis.
Steve, what are your thoughts?
Yeah, no, I echo Eric. I don't think we're necessarily in a bubble. And I think, when I look at some of the dynamics at play here, whether it's certainly cheap capital, an influx of a lot of buyers into this particular space, I think just the macro trends driving a lot of these markets, I don't think we necessarily see significant changes over the next, 1 to 3 years. And I think with multiples, I mean, if I looked at where they were, say, 2, 3, 4 years ago to where they are now, we've certainly seen a run up. But I'm not sure those are necessarily going to significantly change over the next couple of years. I think our general opinion is that's here to stay. And I think we just, speaking for Advanced Street, have to remain disciplined and really focus on the quality, highly differentiated businesses, which has always kind of been what we've tracked after versus, those that might be a little bit lower on the complexity spectrum.
Now, Mike, do you agree with your fellow panelists there?
Yes, I do actually. Access to capital, cost of capital, all underlying drivers, but also, I see that just a continual trend of the strategics that rather than organic initiatives from a development perspective, they're more on a search and development with inorganic growth initiatives, looking to buy technology and execute in that regard. I think it perhaps is much more efficient and especially with accelerated regulatory pathways, that it's an interesting dynamic that I continue to see in the space.
There you go. I like it when all my panelists agree.
Right.
So I'm going to kind of shift to, talking a little bit about more your firm's positioning and kind of just having the audience get to know kind of what you're focused on a little bit better. So, I mean, maybe it'd be good for the audience to understand a little bit more about your firm by understanding a few of the companies you currently have in your portfolio. Steve, you want to start?
Yeah, sure. So, I think Advanced Street, as we walk through some of these companies, you'll certainly see a theme. And for us, we really look for highly differentiated niche medical device and life science device manufacturing businesses who, are typically number 1, 2, or 3 in their respective markets. And within that, there's a lot of embedded manufacturing IP process know-how. So a couple of the businesses that we've partnered with in the past couple of years that, some of the panelists here might recognize would be Motion Dynamics, which is a business that focuses on some of the world's smallest micro wires, coils, and springs, and entrepreneur-owned business founded by Chris Witham over in the western part of Michigan. And Chris has just done a great job of really positioning this business in a lot of the high growth interventional therapies, whether it be neuromodulation, neurostimulation, a variety of different advanced catheter and guide wire therapies. But a great example of the types of businesses that we like to partner with. A similar one would be Applied Plastics, Applied's actually out in Boston, Massachusetts, and they do PTFE coated mandrels and coated wires that are used in certain cases as a manufacturing aid for advanced catheters. In other cases, they would go into, say, a pull ring assembly for a steerable catheter. But similarly, a very differentiated business when you look at the material science and know-how that goes into the PTFE coatings that they have. Another entrepreneur-owned business that we partnered up with Dave Ring, and a third one that we recently partnered with just about a year ago was YTech Industries. And YTech makes some of the world's most specialty core wires that would serve as kind of the building block for a specialty guide wire that goes into far-reaching areas of your peripheral vascular system or neurovascular system. So, again, for us, partnered up with the Castellino family, a great leader in a niche market, and I've had a lot of fun working on kind of building out the foundation of these businesses that have a lot of organic tailwinds, but expanding capabilities, building out the sales channels, and looking at the org chart as well to continue to bring in talent as certain key family members might look to transition over time.
That's helpful. Thanks, Steve. Mike, you want to talk about some of the companies with that Riverside is a part of right now?
Yeah, and again, founder run type of businesses, lots of growth runway associated with these businesses. I had mentioned pharma services. Just recently, we invested in a company called Synergy Pharma Consulting. They are a local company outside of Boston, actually, that focuses on chemistry, manufacturing, and controls services for biopharma and pharma. This is more of the technical, regulatory compliance type services for early stage single molecule venture-backed companies all the way to blue chip pharma and biotech. Another company in our portfolio, Innovate Medical. Innovate, actually very different company. It is the leader, the U.S. leader in these are mobile medical workstations, the workstations that tie directly into the electronic healthcare record systems in hospitals that really facilitate clinical workflow for the nursing staff. Another business is in the hospital, tech-enabled hospital services business, a company called Revicor, the top player in the U.S. in tech-enabled revenue cycle management solutions for hospitals. Here, really focused on underpayments, collections, denial adjudication, all based off of technology of thousands of algorithms to collect, identify and collect underpaid claims for hospitals. So that's especially relevant today in the space. So those are a few from different subsegments that I'm involved with.
All right, thanks, Mike. Eric, you wanna wrap us up with some of the companies ExcelMeds currently invested in?
Sure. I'd say in general, Dan, we're looking for companies that have launched commercially, achieved, some amount of revenue. Our, strict criteria, 10 million for a growth investment, 20 million LTM for a control type investment. And I'd say, a lot of times these companies, they were able to get initial commercial traction to cross those thresholds. Then they ran into some kind of challenge where top line growth sort of stagnated. Maybe they went out and took debt, kind of complicated the capital structure. And to a large extent, found themselves in a position where they're not able to attract, the growth capital. Many funds are sort of put off, by this, too many questions. We've been able to dig into these companies, and then through just a bolus of capital. And, and as I mentioned, at the outset, a lot of the team, roots go back to being associated with the venture funds that ExcelMed had. So there's a lot of knowledge of what may be out there from a technology perspective that we're then able to bolt, onto the companies and, re-accelerate, top line growth and create value for everybody. And, example of that public company was Cogentix, which ExcelMed, acquired, really had been flat top line growth as a public company year over year, not really going anywhere. And ExcelMed came in, made some management changes, brought in some additional assets and sold the business 15 months later to Laborie. So I think it was valued on the public markets at 30 million market cap and sold it for 240 million 15 months later. Keystone Dental is another company, which we haven't, exited yet. But again, it's I think, very illustrative of the type company we're looking for. About 50 million in revenue, had been private equity owned. A lot of challenges. ExcelMed was effectively able to acquire the company. I think that private equity firm just needed to exit the position. So we were able to, acquire it, and then we've made 2 significant, M&A deals for the company, and have really changed the profile of the company. It's back into growth, and now we've, positioned the company where, an exit in really 3 years' time at a significantly higher, valuation is achievable for us. And then recently, ExcelMed came in. This was kind of a COVID deal, where NeuroPace, which recently IPO'd, had some debt outstanding. And again, a lot of times, equity doesn't want to get behind debt. We're not afraid of that, right? If the circumstances are right. We're not afraid if the company has negative EBITDA, as long as it's not, exorbitant burn. And, but we were able to come in, invest in the company, and then IPO it 8 months later. And, that's a company that wound up being recapped at, I think the public data is 50 million pre, and then IPO'd at a $600 million valuation, 8 months later. Those are type situations where I think we've, had a lot of value add.
All right, that's helpful, Eric. We actually just had a question come in that I think fits as we're talking about some of your portfolio companies. And can one of you explain the difference between a platform acquisition and a bolt-on?
Yeah, Daniel, I'm happy to jump in here. I mean, I think for us, sometimes it comes down to the size mandate that we have, using AdvanceRate as an example. So, in certain cases, we're looking for a platform that might be a minimum of $30 million of enterprise value up to 300. And that for us serves as a platform that we'll look to build over time. And for us, the focus would be predominantly, finding businesses with great organic tailwinds. But I think more often than not, as you think about a bolt-on or an add-on, sometimes it falls below that size threshold. And in certain cases, it could be, a team that just wants to be part of a larger organization with a very complementary, in our case, product set capabilities. But I think size to a certain degree sometimes comes down to, and it really is dependent upon, and my other panelists can jump in here, but dependent upon the size and mandate for that particular fund's platforms versus what might serve as a more complementary add-on.
Thanks, Steve. Now, I think it's in the title. You're all financial firms, so we all obviously think of capital first. But when we're thinking about a company that gets brought into each one of your firms, what do you feel you offer besides capital? Mike, I'll start with you.
Yeah, I think, for me, I was an operator for 22 years before I didn't grow up in private equity. I've run several medical device and diagnostic companies, and I've been at Riverside for 9 years. And if I've learned anything over the past 9 years, is that these are good companies, whether or not they met us. And really, for us, maybe the founders are at a point where they want to take some liquidity, take some chips off the table, roll some equity with us going forward, and take the ride to maybe take the company to levels that they dreamed about. And for us, we go into these investments with a really strong growth thesis. And it's the fundamentals are, of course, making sure we've got the right people on the bus and working with the founders and filling gaps in the executive leadership team. Very often these companies don't have a real strong BD function, and so we'll help establish a go-to-market strategy and maybe blow out business development, and maybe depending on the sector, the subsector, contribute to insourcing or outsourcing manufacturing, taking a company international, doing what we just talked about, these bolt-on acquisitions, maybe to access new markets, new services, technologies, customers. And at Riverside specifically, I was involved with Riverside before I joined. While I was running my last company, I was a member of Riverside's Healthcare Advisory Board. And today I chair that group. And it's a group of about a dozen or so executives from different sectors within healthcare that I described: device, diagnostics, pharmaceutical services, healthcare IT, and this isn't just window dressing. These are folks that are intimately involved with us and our portfolio companies. They help with diligence, but more importantly, they'll serve as independent board members. They'll help open doors. Will leverage their connections to get warm prospective client referrals, and that has really paid back dividends in almost every portfolio company that I've been involved with. And more importantly, I think most importantly, we never pretend that we know a business better than the executive leadership team or the founders know a business. It's really trying to figure out how we can plug in and add value to really bring that growth thesis to realization at the end of the day.
That's helpful, Mike. Thanks for the context there. Eric, I'll turn it over to you. Same question.
Yeah, I mean, I would say the value add that Mike articulates, from Riverside is very similar to the way, the team at ExcelMed also approaches it. The general partners, managing partners, have extensive Rolodexes. It's always amazing to me how quickly we're able to, just pull from our networks, personal networks, top leadership throughout the industry, to help us assess, as well as our operating partners, as well. So I think, a lot of the same things that Riverside is doing. I think one thing that I've seen from ExcelMed that's different than a lot of private equity funds is the idea on these bolt-ons. The challenge I've seen with other funds, and this is just from when I was a banker, and I'd see private equity acquire a company, and then they would articulate a strategy of adding, growth technologies on. But where traditional private equity, I think, has a challenge is a lot of the technology companies you want to add are EBITDA negative. And a lot of funds only think about things in terms of EBITDA multiples. And again, going back to our team's venture roots, we just don't approach it, that way. And also, their access to, there's a lot of, I think there's over 500, emerging medical technology companies in Israel. I think we have unique access there as well, just given that's where the roots of the fund began. So identifying those companies, a team that brings, I think, more of a venture approach and a real need to stimulate growth, through M&A. And again, I think, the proof is in the pudding. I think in all of our portfolio companies, we've done several, M&A deals to help get that growth going.
That's helpful to better understand that perspective at ExcelMed, Eric. Thank you. Steve, I'll let you finish with that one. I know you had previously touched on kind of IT and building out sales support, but go ahead.
Yeah, no, I mean, I think this will probably sound very similar to Eric and Mike, but there's kind of an infinite number of check writers out there these days, and more coming in. So I think how you differentiate yourself beyond that's certainly an important part. And I would say for us, focusing predominantly on entrepreneur-owned businesses and management-owned businesses, one of the key themes would be flexibility, and just really listening to those entrepreneurs and listening to the family members when it comes to what they want out of the transaction, whether it's a CEO who wants to remain in the role of CEO, but take some chips off the table and have a bit of estate planning, but a bigger bank account sitting behind them to grow that business into adjacent capabilities or products. Or, in other cases, it could be a founder who wants to begin to transition back into the engineering and product development role that they enjoyed. So bringing in a management team, but really listening closely to what is the right fit. Because I think, one thing that we're really cognizant of Advanced is just the culture. And who are those important people that built the business? And in many cases, these are multi-generational businesses that, the name that hangs out front of those buildings is incredibly important. So, that's something that we really pride ourselves in is, listening and trying to understand what's important to them. So, I mean, I think there's a lot of different flavors of private equity out there and financial buyers. And I think for us, it's really focusing on trying to, partner up with the best in class and then listen to how can we help build out the foundations of those businesses. So is it, to your point, focusing on sales and what is the right strategy? Is it, a sales rep? Is it direct? Is it a hybrid of the two? And looking at how we can try to leverage our network of operating partners to, help them achieve some of those goals and objectives better. Certainly the quality arena is one that, with entrepreneur-owned businesses, that's maybe not always the most fun to focus on, but are there ways that we can help them, whether it's getting, ISO 1345 certified? Is it trying to help them build out the infrastructure to better serve, customer quality audits? So really trying to look through the different foundational areas and figure out how we can help them with our network of operating partners. And I think that's kind of ingrained in our DNA with, some of our managing partners and partners at the firm having worked and run MedTech businesses and life science businesses.
Yeah, really helpful context, guys. I think as we've already talked about, there seems to be an endless amount of private equity firms out there these days. So finding the right partner that can bring just more than just capital to the equation can really make a big impact after a transaction. I'm going to shift to, I think, deal origination, or how you discover your opportunities. When thinking of deal originations, do you see your deals result more as part of your strategy, execution, and outreach, or do you typically see more things come in from a business owner or potentially their M&A advisor? Eric, I'll start this one with you.
Yeah, thanks. No, look, it's a mix for sure. I mean, I would love to say that we sit down and craft, grand strategies and go execute on that. But that's just not the way the world works. And so, it tends to be a mix of all of the channels, that you mentioned, Daniel. And for us, because we're exclusively focused on health tech, and because to our LPs, we've made the commitment, like we're not going to invest in companies. So much of de-risking in health technology is just told through the revenue story. It's really, you have to be north of that 10 million LTM revenue for us to consider a growth investment. And that could be a check, 15 to 40 million, and then, north of 20 million for the control type investments. Beyond that, I think, we feel like we do have the in-house technical and also the external resources to diligence opportunities. And so we really tend to not become laser focused on just a particular therapeutic, segment area. It's more about that financial profile for us.
Thanks, Eric. I'll go ahead and turn it over to you, Steve. When you think about deal origination, where do most of your deals come from?
Yeah, I would say, we certainly will see in excess of, call it 600 deals a year, but a good number of those, are us looking through our network, trying to make sure that we're active, mapping the markets. And in certain cases, our existing portfolio companies are great when it comes to making introductions to, families and businesses that they think that we might be a good fit to partner with. And that is how we've, in certain cases, generated activity. But, for us, it's much more of a, deal generation that originates from, those in the firm reaching out and getting to know entrepreneurs over time and getting to know, families over time, knowing it's typically going to be a very long courtship, given this is a significant decision for a family, a significant decision for an entrepreneur, and getting to know them over a multi-year period becomes pretty important. So it's, planting a lot of seeds and trying to make sure that we're active in identifying what are those, market trends, market themes, manufacturing technologies that have a lot of tailwinds over the next, 5 to 10 years, and map those accordingly.
Thanks, Steve. Mike?
Yeah, a lot of the same, Daniel. We have a partner at Riverside that's just responsible for deal origination. That's all he does. But we have active internal targeting projects on specific subsegments that we have a strong interest in, and so it's really trying to establish those relationships. I think that Steve had mentioned that take a long period of time and that comfort level, but it's a mix for sure.
So I know you all see a lot of opportunities come in each year. What do you think is one of the biggest mistakes that you see a seller make when they are trying to exit their business? Steve, I'll start with you.
Yeah, good question there. I think the upfront preparation that a seller, makes and ultimately takes can really lead to a more successful outcome, or, lead to maybe a higher risk of something coming off the rails in the process. And I think whether that's a sound legal advisor, whether that's spending time, really making sure that your financials are clean, whether it's a quality of earnings up front,
right,
if there are lingering quality issues or CAPAs, trying to make sure that, as with anything, the more preparation and more upfront work that you do is typically going to lead to just a cleaner deal, a quicker close, and and less surprises as you go through the process. So I think it's really trying to spend that upfront time, and whether that's 6 months or 12 months, but to get the business ready to sell.
Yeah, I think managing expectations and preparation. Absolutely, Steve. Mike, how about you?
Yeah, I mean, I agree fully. I mean, really not being prepared for the lift, if you will, the depth of diligence that's required, and more often than not, if a banker is running a process on a company, pretty much they have that addressed. But for the entrepreneurs that we've sourced organically and the businesses, it can be difficult just kind of navigating through that. And I personally, I find too that those who are too aggressive with forecasts, with no line of sight or visibility, or with a really tangible pipeline, I think that's a big mistake.
Yeah, no, that makes sense, Mike. Thank you. Eric?
I think everything Steve and Mike said 100% right. I mean, very off-putting to me when sellers put very aggressive forecasts. It's almost insulting, right? I mean, all of our general partners, managing partner, we've all been in the sector for 20 plus years. We know, what a credible and attractive top line looks like, and what a ridiculous, top line set of projections look like. And then, also sellers who are just over the top aggressive on valuation right out of the gate, before we even had a time to really sort of, kind of get pregnant with the idea. And, the back of my mind, I'm always like, look, if that's the valuation you want, you're probably looking for a strategic buyer, right? Who has a lot of synergy values to deliver to you. And if you're talking to financial buyers, it's just a different calculus, in many cases. So, but I think, what Steve and Mike said really is sort of the, the top errors that sellers make. They just don't prepare themselves and things fall apart in due diligence.
No, that makes sense there. Eric, I think, bringing up valuation kind of, brings me to my next question. I'm often asked from business owners about valuation, and what are some of the key drivers of valuation at your firm? What are ways businesses can ensure they secure the maximum value? And you often see a huge range of multiples for similar sized companies. Mike, I'll start with you.
Yeah, I think with for us, we have a real strong understanding of the different sectors, the subsectors, what multiples are typical in those segments. For us, it really we really try to focus too on the management, the sustainability of the business. The potential growth trajectory of a business, the total available market, but also I think, as Steve had mentioned, being able to look at downside base case, upside cases of financial modeling, and what that means to us at the end of the day in terms of cash on cash return and IRR modeled out. So I think there's lots of independent variables, and it depends on the segment and the subsegment.
Thanks, Mike. Eric?
Yeah, for me, I guess I always kind of start at what market segment are they in? What are the growth prospects for that sector? That's kind of where, for me, I start to frame value. If you're in, for instance, say cardiac surgery, the secular trends there, right? Just doesn't matter how great your technology, et cetera is, that market is shrinking. And so that kind of becomes a trap, if you will, on value, or cap on value for that seller. And so I start, really from there. And then, it becomes sort of your standard due diligence of like, what is the quality of the asset, the quality of the management team, what's our potential to bring, in additional technology, et cetera, to, get quote unquote multiple expansion and create value. At a high level, that's sort of how I start thinking about, valuation framework.
All right. Thanks, Eric. Steve, how about you?
Yeah, I think Mike and Eric really hit a lot of the key themes. I mean, I think we take a similar approach to, what markets or therapies does that particular business have exposure to? And then, I think the overlay of that is, how differentiated are the capabilities, the products, and then how scalable is that business as well? What's the infrastructure that's in place? And then how much investment might need to go into that business to enable them to achieve the growth rates that we might see across those particular therapies. But, I think, another overlay is, as you look at the business, is there a certain level of diversification within the customers? I think a business that's got 80% of their revenue with one customer versus 15% as the largest customer, I think that's typically a driver that you'll certainly see. And then, I think that defensibility or competitive moat that they ultimately have. And sometimes I think that gets almost into what market they're playing in terms of how sticky is that revenue base, and how differentiated are they versus kind of some of the more commodity businesses. So certainly a lot of different, I think, factors and levers that go into ultimately trying to drive, what that evaluation multiple ends up being.
All right, thanks, Steve. Now, maybe somewhat similar of a question to one I asked just a second ago about common mistakes sellers make. But once you've entered into an LOI with the company, what are some common issues that sellers face that cause a deal to fall through? Eric, you want to start us with this one?
Well, I mean, once we sign an LOI, I mean, there's usually a high degree, of conviction to get a transaction done. I would say, right, we've done a fair amount of due diligence, at that point. So, I mean, I hate to say, short of just an outright, lie or something like that, or, some kind of material adverse event. But, we are really committed to getting that deal done. So it would have to be something pretty significant, IP, some kind of, hole in IP that wasn't uncovered in preliminary, due diligence, I guess would be, maybe one of the most obvious things, because typically, you're not really digging in on IP until the latter half of due diligence, anyway. So, look, anything, I mean, a variety of things, right, as we all know, can kill a deal ultimately, but from a fund perspective, I mean, we're really focused on getting a deal done once we issue an LOI.
Steve, anything to add to that?
Very similar to Eric. I think we try to do an enormous amount of upfront work so that whatever we put in front of a seller, we can stand behind and ultimately transact at. So, it typically has to be something that's, comes out of left field, whether it's significant environmental issues, you've contaminated the groundwater, something to where it's just, wasn't foreseen, that creates, such a liability that it makes it hard to ultimately move ahead. But, I think, at a certain level, making sure there's, very regular communication, I think, the stories certainly get out between, lawyers batting drafts of a purchase agreement back, 20 times. I think for us, we always say, let's be quick to just over communicate with the seller and jump on the phone and chat through it, not let it be a game of telephone at any point in time, really, over any issue.
Yeah, we always talk about transparency with our clients and being as transparent as possible up front. And that often helps to avoid some of those issues post LOI. Mike, any additional thoughts from you?
Yeah, they really nothing significant more. I mean, we spend a tremendous amount of time getting to that stage. There's this certainty to close, and if there's a major Q of E discrepancy that arises, or clients walk or management walks or something like that. I mean, that's it would have to be of that magnitude.
Now, can you guys describe a typical deal structure just real quick? How does that look from your perspective? As far as, I mean, obviously there's going to be cash involved, but will a seller see milestones, equity, financing? How do you view that, Steve?
Yeah, as far as, speaking on Vance Street, we've typically kept it fairly straightforward in terms of, a cash purchase price. We haven't really gone down the path of seller debt financing. When it comes to reinvestment, we typically are one to say, we don't have a hard line where you have to invest 20% or 10% or 30%. And, but just, I think philosophically for us, forcing someone to invest, in a business that, that's their money, that's what we're paying them for. We certainly hope that they like our growth thesis enough to want to partner together. But, I think we take a pretty flexible approach, and, I think in certain instances there could be an earnout, or a milestone payment, but that's typically when you see, some significant revenue event that maybe isn't perfectly diligenceable, but there's a high degree of confidence in to try to help bridge a valuation gap. But typically for us, it's fairly plain vanilla.
Mike, how about you in Riverside?
Yeah, the same here, cash, we have done deals. I've been involved with deals where there's been milestone earnout payments. I think every deal that I've been involved with in the past 9 years, the founders have rolled some percentage of equity with, not that we've required it, but they've chosen to roll some percentage of equity with us going forward.
And Eric, how about you?
A very similar approach to Mike and Steve. And I love to see when the existing investors roll equity. I mean, again, we're financial buyers. We can't get to the same valuations often as strategics. And so I like to see those folks have, enjoy some of the upside that, I know we're going to create, over time. We've done things, like above a certain return, sharing, additional upside, with the existing investors. We want everybody to win, right? And that's the way a good deal, to me, that's the way, the definition of a good deal is everybody won.
Now, so once you close a transaction, kind of looking at what are expectations for an owner following a transaction, what's a typical role for an owner after you've acquired a company, and what does the first 100 days look like once you've closed the deal and you have a new company in your portfolio? Mike, you want to start us off?
Yeah, sure. Every case, of course, is different. More often than not, the owner wants to continue to run the business. We had cases where the owner wants to transition over time, perhaps, and be on the board, take a board role, and help us recruit a CEO, or I'll come in as an interim CEO for a period of time. But the first 100 days, Daniel, honestly, I mean, we strive to have no surprises on either side. And before we close, there's a consensus on a 90-day plan. And most importantly is to get alignment with management. I mean, we ensure that nothing dramatically changes. Employees still come to work every day. Day to day should not change for the employee base. And we just want to make sure that together we have that foundation to execute the growth strategy. So very often the companies in which we invest, we find ourselves working with the team to perhaps bring in a professional CFO. There's a heavy lift, as I say, from a financial reporting perspective and getting into that rhythm of reporting, especially if you have debt financing and lenders involved with the company. We typically get aligned on performance objectives overall for each function of a business, and begin to execute the growth strategy.
Absolutely. The preparation begins before the close. Absolutely, Mike. Eric, how about you?
Yeah, I think, very similar, as to what Mike laid out. I mean, I think the point he made about, there should be no surprises, right, upon close. And, I think the existing owner should expect us to be very curious. I mean, typically we're investing in it as a control, investor. So we want to, understand the asset that we've now acquired, but, we're not operators, right? I mean, I spent several years carrying a bag, in the OR as a sales rep, but, we're not coming in to run the business. We want management to do that. We want to, try and be helpful, creating value, thinking about exits and that sort of thing. So again, from the day to day, they shouldn't expect any major changes, from what they've been doing. Hopefully the capital that we bring, helps them just turbocharge the activities they already had, ongoing.
And then Steve, you wanna add anything to that?
Yeah, I don't think Mike and Eric have left me a whole lot because they really hit on the general themes of playbook. But, I think, to Mike's point, for us, it's mainly entrepreneurs or families. There is a range of desires of the entrepreneurs in terms of remaining as the CEO or transitioning out over a period of time. And I think one of the fun things has been seeing an entrepreneur who said, I'm ready to transition in the next 3 months. But, once admin HR tasks get taken off their plates. All of a sudden, lo and behold, 2 years later, they're there having a lot of fun and getting back to, I think, what they enjoyed doing in the earlier innings of building that business. So, I think that's one where we certainly always strive for that. And to Mike and Eric's point, if we've done our diligence correctly, really limit the surprises and begin to, over that 100-day plan, think more about growth, hold a strategy session, invite some of the key sales reps, distributors, customers to begin to think about, what fence we're swinging for in the next 3 to 5 years. But I think Mike and Eric really hit on a lot of the different points for us.
I had another one come in from the audience that I wanted to ensure we got in, but we've been talking a lot about sellers exiting to your firms. When do you think about exiting your portfolio companies, and what's the average time you're invested in a company? I think Eric, I'll start with you.
Yeah, good question. It's obviously going to vary. I would say across now the two funds, I mean, we've had, several exits, and, candidly, it's been that, sort of 3 to 5 year window. There's some that have happened faster, and there are some that are taking a little bit longer. But because of where we're investing, the revenue profile, of these companies, and, just where, say the MedTech IPO market is, or what buyers are looking for, we tend to not be that far, call it striking distance from an exit, on average.
Steve, what about Van Street?
Yeah, I would say, similar to Eric, it's kind of one of those, it depends, but I think for us, and this is what we certainly tell our investors, is that this segment of the market, typically it's a longer hold, because you don't win a new customer overnight. You don't, break into new therapies or new capabilities overnight. And that's one of the things that we certainly like about the med tech market, is that it's very sticky. And those customer relationships, get developed over many years. So, I would say, for us, it could be, certainly 5 and well in excess of 5 years. Because, one of, I think the biggest challenges for us is finding great businesses. So once we found a great business, a great family, a great team, we want to try to obviously continue to grow and partner, and our investors understand that on our end.
Thanks, Steve. How about you, Mike?
Yeah, I think in the 32 years Riverside has been in existence, we've exited once in less than 4 years. And that was just because of a crazy offer that came over the transom that the founder said would be crazy not to take. So we're more longer term, disciplined, patient investors, typically, 4 to 6 years, sometimes 8 years, just depending on, executing that strategy, and ensuring that we've done what we said we were going to do.
All right. Well, I see Brian's jumped back on the screen. So before he takes back over, I just want to say a special thanks to Steve, Mike, and Eric for joining me today for this webinar and being participants in this panel, as well as a special thanks to the audience for attending today and taking time out of your schedules for this event. Thank you very much.
Thank you, Daniel, and thank you, Steve, Mike, and Eric, for your excellent information. I think everyone that attended today and everyone that's going to watch this video is going to learn a ton about this process. It's an exciting time in medtech. It's always been a field that is fascinating when it comes to exits and liquidity events. It's great to see 3 terrific firms that are involved in that and hear your perspectives. Well, that concludes MedTech M&A from the buyer's perspective. I want to thank MedWorld Advisors for your support as always. And I want to thank everyone who attended today for joining us and taking some time out of your day. I will look forward to seeing you all again at our next program. And if you are in Boston next week, please register for the Biomed Device Conference and come check out our MedTech Showcase in Startup Stadium. We're going to have a ton of live in-person programming all about featuring startups and also discussions with strategics, and then also a great discussion in the afternoon on manufacturing and the lessons we've learned so far in COVID. So thank you so much, everyone, and have a great rest of your day.